Hello, my name is Tom Nealon, and I'm an advisor with CCR Wealth Management. As advisors and planners, we work closely with our clients in developing strategies to accumulate wealth and to preserve that wealth through investment and saving plans. We also plan for income flows for retirement, education, charitable giving, and endowments, and other important life events. An important and sometimes overlooked component of all of this is making sure appropriate insurance plans are put in place to protect these goals. Life insurance, disability insurance, and long-term care should always be an important component of any financial plan. Obviously, proper health insurance should be put in place, but for the purpose of this session, I will focus on the aforementioned three. Life insurance can have many uses, but first and foremost, it should be used to replace income in case of a premature death. In most cases, this benefit is received tax-free. Benefits should be sufficient to support beneficiaries still in need of income and to continue short and long-term planning that has been put in place or will be put in place. Benefits should be sufficient to support beneficiaries still in need of income and to continue short and long-term plans that have been put in place or will be put in place. The amount of benefit will vary depending on individual situations, but should include the following factors: age of dependence of beneficiaries, years needed for additional income, earnings potential of beneficiaries, amount of household debt, and savings plans or investment plans that have been put in place. A common quoted benefit is 8 to 10 years of current income, but that can vary substantially depending on individual situations. In general, there are 4 types of life insurance, and 3 of those accumulate cash value. Term insurance is the least expensive. It insures for a specific period of time, usually at a level premium. In most cases, the insurance will terminate at the end of the term. Whole life, sometimes called ordinary life or straight life, is a policy which is guaranteed for the lifetime of the insured as long as scheduled premiums are paid. Whole life premiums are fixed based on the age of issue and usually do not increase with age. It is usually the most expensive form of insurance, but also has the strongest guarantees. Universal life earns a fixed interest rate on the cash value. The interest rates can vary, but can't drop below a guaranteed rate. Universal is the most flexible form of insurance. As long as there is cash value and sufficient premiums paid, the premium can be increased or decreased, can be suspended for periods of time, and then can be reinstated. Variable life allows cash value to be invested in the equity and fixed income markets. Values will be based on the performance of the investments. Because of the variable nature of these policies, variable life is deemed to have the most risk. Cash value policies have a permanent nature and do create wealth through cash accumulation. They are more expensive than term, and because of the permanent nature, they usually require a much longer commitment to funding. Again, the important takeaway of all of this is to make sure that the appropriate coverages are put in place for the specific time period needed at an efficient cost. The objective of long-term disability is to generate necessary income if household income is eliminated or reduced due to an illness or injury. Such a loss can be devastating to not only long-term plans, but also day-to-day living. A commonly designed policy, for example, would generate 60 to 66% of pre-disability income as long as the insured remains disabled until age 65 or later. Keep in mind that if the premiums are paid by the insured, that the benefit is received tax-free. If the premium is paid by the employer or another third party, the benefit can be treated as taxable income. This can greatly affect the amount of benefit needed. Policy design can have many variables or options. These can include waiting periods before the benefit starts, the length of the benefit, and the amount of benefit applied for. All of these can impact the cost and the level of risk to financial objectives. These should be thoroughly researched to achieve the optimal policy for the premium spent. Long-term care is different and a bit more complicated. First of all, it is designed to protect accumulated assets, as long-term care is a key risk to retirement planning. In Massachusetts, for example, the average cost of a home health aide is over $5,000 per month. For a semi-private room in a nursing facility, the average cost is over $12,000 per month. Currently, there are four main ways to pay for this. Government programs such as Medicaid, traditional long-term care insurance, hybrid policies that combine long-term care with life insurance and/or annuities, and personal savings. Government programs such as Medicaid, traditional long-term care insurance, hybrid policies that combine long-term care insurance with life insurance and/or annuities, and personal savings. Many people think that Medicare will cover long-term care or custodial care. It does not. Medicare is funded by both state and federal government and works differently in each state. It provides financial assistance for long-term care for the needy and is both difficult and time-consuming to qualify for. One usually has to spend down assets before Medicaid can be applied. When deciding to insure long-term care, there are a number of factors to consider. When to buy. The younger you are, the less expensive the insurance will be. Also, earlier in life, it will be less likely that one would develop health conditions that would preclude one from securing coverage. However, by purchasing younger, one will most likely be paying premiums for a longer period of time. When do benefits begin? How long a waiting period is optimal? Do you have assets or income that can support a longer waiting period? How much coverage to purchase? Do you have sufficient assets or income to cover some of the cost? It is possible that one does not need to fully insure the cost, which can greatly reduce the amount of benefit needed. How long a benefit period? Currently, the average stay nationally is 3 years. All of these factors can affect the cost and have an impact on the overall level of risk on one's financial plans and objectives. All of these factors can affect the cost and have an impact on the level of risk of one's retirement and financial plan. In closing, discussions on insurance focus on negative things that can derail plans. Not pleasant to discuss, but necessary. The overall goal of insurance is to protect what has been put in place and what will be put in place. Financial plans need this component. It should be carefully thought out and reviewed periodically as part of the overall financial planning process. As always, please contact your CCR advisor if you have questions or need additional information. Thank you.